Okay, we do have quorum now, and as Secretary of the ERS Board, I'd like to call the meeting to order. And the first order of business, since our chairman and vice chairman are not present, we need to elect a chairman pro tem. And Randy Thurman has volunteered, but we do need a motion to elect him. Thank you, Carla. Second. Thank you, David. All those in favor signify by saying aye. Aye. Anyone opposed? Fantastic. There, Randy.
Thank you.
This one's yours. Sorry.
Call the meeting to order. First item of business is to approve the minutes of the meeting of January 14, 2016. Motion has been made. Do we have a second? Second. All in favor, please signify by saying aye. Motion carries. Item number 3, presentation by Brandywine Global, update on the Opportunities Fixed Income Portfolio.
Just to introduce, Greg Zavoina from Brandywine is here. Brandywine is your global bond manager. Certainly a good time for Greg to come in and give you an update on their strategy and team. This is just the regular course of due diligence meetings that we're having managers in. With all the volatility in the markets, currencies and emerging markets certainly impacting that, we thought it would be a good time to have them come in for an update. So I'll turn it over to Greg.
Thank you.
Morning.
Good morning.
So as Jason said, my name is Greg Zavoin. I'm a Senior Vice President with Brandywine, concentrating on relationships such as yours. So you have my presentation in front of you. I'll give you a quick sort of update to the firm. I'll talk to performance and attribution, really what drove performance, as well as how the portfolio's positioned, given all the volatility that we're seeing in the world. And then at the back, there's some pages. Some of our guys put together a lot of macroeconomic stuff. I'll just talk to a couple of those pages, really the ones that are most relevant to our case. So, and as always, I would encourage you to ask questions, as they come up, or you can wait to the end. It's really, it's 100% up to you. So, as far as the firm update, at the end of 2015, we managed about $69 billion under management. Assets have grown certainly over the last 5 years or so. Global fixed income is our largest asset class we manage, right around $53 billion just in global bonds, primarily global bonds. There are some others, but primarily global bonds. But that's where we've seen the majority of our growth, and we've continued to see growth even in the volatility that we've seen over the last 6 months or so. So as far as the team, there's been no changes really to the team. I mean, you still have Jack, Steve, and David running the portfolios. Really, the only addition since we've come on to the overall team is Chen Zhao has joined us as a co-director of global macro research. So what we do is we take a look at everything around the world from sort of 10,000 feet. So everyone's views on the world are important, and that's just another input. So now there's 2 co-directors, so they just sort of throw ideas and butt heads against each other, but those ideas can or they may or may not work their way into the portfolio, but it just gives us another discussion point, especially with everything happening around the world. So really no real changes to the team. Certainly not with the people who are actually managing the assets. Turn to the next page, and we'll talk to performance. Last year was not a good year in both an absolute sense as well as a relative sense. That's coming off 2014, where it was a good year, but we've seen that volatility playing out over the last couple years. And really, 2015 was a series of volatility. It was a good first quarter. Second quarter sort of gave everything back. The third quarter was really what drove performance. As you recall, you had the Chinese devaluation sparked some real concerns, especially into the emerging markets in the third quarter. And really, that's really where all the both your absolute and your relative underperformance came from, as our exposure that we have a good bit of exposure in sort of emerging areas, and I'll talk to that a little bit more. But again, primarily, this year started off a little bit better in an absolute sense. You returned about 2% so far this year, but the index is up about 4.5%. Again, primarily it's a currency play. We own very little of the Japanese yen, as you've seen recently. The Japanese yen, even though they've brought their interest rates into negative interest rates, the Japanese yen has rallied to the point where, a couple years ago it was 86, and then it jumped up to 122, and now it's at about 112. So we saw a pretty good ride, devaluation, and now it's actually picking up a little bit steam. We don't necessarily think there's nothing really in the Japanese economy that points to the continued strength of the yen, but it's something that's adversely affecting at least the relative performance of our portfolios. The next page really just talks to that performance in a little bit more detail. Really, there's two ways to look at it. Our performance, you own both bonds and currencies. In an absolute sense, it really was the bond markets sort of did all right last year as interest rates rose throughout the world, and then they started to come down. And when the rates are coming down, the values of the bonds are going up. But it was the currencies really where we got hurt, and it really just comes to the continued strength. Since about mid-2014, the U.S. dollar has grown strong, and really in our universe, the U.S. dollar, nothing gained against the U.S. dollar last year. In some cases, you have the yen was just about even with that. The euro gave up about 10%, all the way down to some place like Brazil, where it gave a third of its value to the U.S. dollar. We've seen that reverse a little bit here this year, but again, primarily against the yen and the euro, is more of the established, more developed countries. Where it hasn't, where we've seen some dislocation, is that the dollar continues to strengthen against sort of the emerging countries. There was the fact that we didn't own euro last year, or very little of the euro. The fact that it was down about 10% actually contributed in a relative sense. But other than that, I mean, you have Mexican pesos down 14%, the Chilean pesos down 14%. I mean, I have a chart later on that shows these values, but really the relative performance has really been in the currency issues that we're having, and that's bleeding into the U.S. economy. The dollar strength continues to hurt the U.S. economy, and effectively, tightens our economic system here in the United States. And while we all talk about the Fed possibly raising interest rates, the effectiveness of the dollar has really already done that for them. So there's probably no need at this point for the Federal Reserve to tighten. With the dollar strengthening and the overall economic conditions deteriorating, I would be shocked to see if the Fed actually raised rates this year. And that's something that's really new. And we thought they probably would, but given the deterioration that we've seen over the last couple of weeks, even since end of the year, more than likely we won't see a rate increase this year. The next page, again, we can talk to how we position our portfolios in a number of ways, but this one really sort of speaks to how we go about things. The top of the page is sort of our unhedged position. So that means we buy both the bonds and the currencies themselves, and we have a number: the Mexican peso, Australia, Indonesia, Brazil, Hungary. These are countries and currencies that we like. So we like the bonds. I mean, you're buying. Mexico's giving you 6% yield. Australia, while it's a 3% yield, it looks great relative to the U.S. now. The U.S. 10 years yielding about 1.5% or so. And then you get Indonesia at 9%, Brazil at 10%. And that really speaks to what we look for. I mean, our primary driver of value is high real yield around the world. So we're looking for higher yielding securities, but yet the inflation in those countries needs to be under control. It doesn't do us a whole lot of good if we're getting a 10% yield and inflation's at 15%, so which you're seeing in the case of Russia right now. While the yields might look impressive, inflation's sort of out of control, so you're losing money by investing there. So The next piece, partially hedged or hedged positions. U.S. dollar, while we may own 48% of our securities here in the United States, we only own 28% in U.S. dollars. So we've taken some of those and invested those in other countries. Primarily, some recent moves. We bought that 5% position in the Japanese yen, which is interesting in that we haven't owned the Japanese yen since 2006. So this is really our first go in almost 10 years into the Japanese yen. And that just points to their economy, the growing, the aging economy. Really, where are they going to find their growth? You've seen that they've had to go negative with their interest rates that sort of entice growth. And it just speaks to a broader issue. Yet, relative to the United States, maybe at least in the short term, the yen may continue to increase. So we took on a little bit of a position there. At the bottom, as I said, these are all independent or incremental positions. So while we don't own the underlying bonds, we like the currencies. Someplace like the Chilean peso, well, the trade necessarily hasn't worked out that well for us. It's still an undervalued security. Unfortunately, a lot of with the slowdown in China, Chile is a major exporter of copper, and unfortunately, it's affected the Chilean peso. Swedish krona and the Norwegian krone; those are newer positions. Again, we don't necessarily invest a whole lot in Europe Central, but a lot in the periphery. And we have Spain, Portugal, Norway, Sweden, Hungary, Poland. That trade didn't necessarily work out. Last year, we started to think, well, the dollar's overvalued. Do we want to go into the euro? The euro we thought was overvalued. We like the fact that we've probably seen better growth potential in Norway and Sweden. Well, unfortunately, oil continued to tank, and those economies have a greater dependency on oil, so the currency came down. But long term, we still think that's a better play than the euro. So Indian rupee, another one. That's actually worked out well for us. Again, we have the incremental position, Indian rupee. We're not necessarily going to be investing in the Indian bonds. The bond market there isn't mature enough. We like India. We like the Indian story. They've done some great things as far as getting their economy rolling. But again, the bond market, if we're going to be investing billions of dollars, the bond market there isn't mature enough for us to be comfortable with the liquidity, us getting in and out of positions. More than likely, we could probably get into positions. It's getting out of the positions that would be the problem. So that just gives you an idea of where we invest. The next page, I won't even really speak to this, other than the fact that it's well diversified. We have 20 different countries at this point, and that's about as many countries as I've seen. And that probably speaks to the lowering of yields that we've seen across the world. 16 different currencies. That's about right. About 15% or so, both in countries and currencies, are what we would describe as emerging markets. So again, primarily your portfolios are in investment grade sovereign debt around the world, but there are some plays that would be considered emerging markets. And then the last piece, as far as the portfolio, how it's constructed, you have a pretty good yield. As I said, the number one thing we're looking for is high real yield, and the yield on our portfolio is a little bit over 4% or so. So the yield to maturity there, if everything else was equal, and unfortunately, we've seen a lot of volatility around that. You have a pretty good yield pickup, at least relative to the index, which is yielding a little bit over 1% on there. And then our modified duration play at about 7.5 years or so. Again, we've actually risen that, and that's actually paid off well. In that we thought rates, at least here in the United States, and that's where 3 years or so of your duration is coming from the United States. Last year we thought rates rose a little bit too quickly, so we bought some longer-term U.S. Treasuries. That's actually worked out well. We bought a 30-year at 3.1%, and now they're trading at 2.5%. So we've seen some real pickups as far as that's concerned, and you've probably seen that flow through in some of your more domestic portfolios as well. Right. That's probably, the triple C, it's probably some kind of commercial paper. I don't think it's sovereign debt. I think double B sovereign debt, I believe, is Hungary. I'd have to see specifically, but more than likely, right. We bought it at, we probably aren't buying, and you know what that is? More than likely, maybe the mortgage positions we've held for a long period of time, but they've actually been working out quite well. But most of your sovereign debt that we're buying, as I say, I think Hungary at double B plus is the only, and that is a downgrade. On that might be your lowest quality that you hold. But you hold the United States at double A, and Australia and New Zealand both at double A. You even have ones we don't even think of. I mean, Mexico, one of our largest sort of position outside of the United States at 14%, is a single A rated country. So again, as far as positioning, the last pieces I'll talk to sort of are this macro, and our guys put together our macro pieces, and really that's how we look at the, we try to look at the world. And while I won't necessarily speak to every page, because I don't want to necessarily bore you, but page 10 there talks to the performance. On the right-hand side is the one-year trailing returns of all the currencies to the U.S. dollar. You see everything, it's negative. As I say, back from the yen, it's just basically flat against the dollar, down to the Brazilian real at 33%. And really, we haven't moved out of positions, but there's been some pain, both in the rand and the real, and we still see value there. So it isn't. There hasn't been any positions where we've abandoned our positions on that. But again, they tend to be incremental. I mean, you have something like Brazil's about 4.5%. South Africa is about 3%. Again, all the way up. I mean, again, with 20 names or 20 countries in the portfolio, you have the U.S. at 28%. I think the next is Mexico. The Mexico story at 14%. And again, Mexico is tied to the U.S. In a number of ways, in that 80% of its exports come to the United States. But again, just sort of shows you that the dollar strength that we've seen over certainly since 2014 has really brought down the performance, and it's hindered growth, and we'll talk to that. Page 12, a quick sort of approximation of where we are in the global cycle. The U.S. is sort of coming up to its peak, and really the two drivers probably of global growth is going to be the U.S. and how they get this whole transition right. And then you have China at the bottom. They're sort of bottoming and coming out. If China can sort of get it right, they've sort of stumbled on their way to reflating performance. They were really defending their currency when, in fact, they probably should be taking other measures to sort of prop up growth. They were much more aggressive coming out of 2008 than they have been here recently, as China shifts its sort of focus from this industrial sort of nation over to a consumer-driven. They're sort of working that out. They tell everyone to have patience. They have their 10-year plans or so, but the markets tend not to be patient with that. So they'll probably get it right, but they're stumbling along the lines. You probably need to see them get it right for us to really have a return to some relatively strong global growth going forward. I'll talk to page 14, and this is really a negative feedback loop for the emerging markets. And while manufacturing isn't a real big part of GDP here in the United States, you generally get a sense of how the economy is going based on that. And here, what we're seeing is that the emerging markets, while everything's coming down, while the advanced economies. Sort of this line is at 50%. Anything above that is expanding. So manufacturing is sort of growing, maybe at a lesser pace in the advanced economies. The emerging economies, unfortunately, there's contraction, and what we need to see is a return above that sort of line, so that we see some expansionary policies, and most of that is the way of the dollar. With the dollar so strong against some of these emerging economies, they have to defend their currency, and they don't use the other measures, as far as trying to spur growth. Really, they're just in a defensive mode, at this point. So, the one point I'll talk to, and we don't necessarily think that the U.S. is some people would say we're already in a recession. In traditional measures, you have some pretty solid employment. I mean, employment is approaching a point that most would consider to be full employment. Here in the United States, maybe we'll have to see some wage pressures. Hopefully we get some wage pressures. People actually begin to make more money, and that's what the Fed's betting on, and that should drive up inflation from the 1.4 level to the 2% level that they're shooting for. This right here really talks to the bond spreads, so the spreads of what corporations are borrowing relative to the U.S. Treasury, and this tends to put some stress on businesses, but this is really, as the spread grows, as you can see back in 2008, the spreads really shot up, and that's when we ran into a recessionary period. But this is really the only indicator that's pointing towards any stress in the economy that would point to maybe a recession. Again, growth by no means, growth in the United States is by no means excessive, but we don't necessarily think that it's recessionary. And then the last piece I'll really touch on is page 18. And this, while we don't necessarily have a bet on, this is how we look at the world. And really, we consider this decrease in oil and commodity prices really to be a $2 trillion tax cut. And really, there's typically a 12 to 18-month lag between the time, when, we all started paying less for gas, and then when it actually hits the economy. And really, what we're seeing here is global GDP. It sort of tracks along those lines, and if you take it out 18 months, we probably should see a spike. So our expectations are that probably in the second half of this year, we'll probably see some of that money actually coming back into the market, into the economies, and we should see some growth going forward. So I mean, that's our expectations. It's been a little slower than we've expected so far, but that might be reasonable given people's expectations. Okay, I'm going to save here a little bit. I'm not going to get burned like maybe I got burned in 2008. But eventually that should work its way into the overall economy. And then really the last piece I'll talk to is the last page, and that's really opportunities in bonds. So typically we're going to buy something that's undervalued and then we're looking for it to revert back to its mean, and then at that point there's no value, so we sell it. So typically this last piece, opportunity in bonds, it's the same situation in currencies. 4 years ago, the U.S. dollar was undervalued. Right now, it's the most overvalued currency in our universe. But as far as bonds, if you look out over here to the left, really these are the highest real yields. So this is the 10 years in some of these countries, taking out inflation. So you have places like Brazil and Indonesia and South Africa yielding 5.5%, 6%. Really, these are the countries that we own, from Brazil to Indonesia to Mexico, certainly. And then you go all the way over to the ruble. I mean, so Russia, as I said, has negative rates, but yet in our universe of currencies, it's the most undervalued. So you have to look at it. We just don't take it, on its face. We actually look into it. It gives us, this will say, okay, well, maybe we need to look into it. Well, you look at Russia and we'll back off on that one. So it's got undervalued currency, which would be attractive to us, but then you look at what's happening in the country, and so we'll back off and wait for better times, maybe to invest in that. So that's always something that we look at. But just because it pops up on the screens and looks impressive, we don't necessarily invest in that. So, we look for 2016 to, some clarity coming forth. We didn't really get a whole lot from the Fed yesterday. Maybe a little bit of dovishness, but not, to at least acknowledge, that the dollar strength was there and was weighing on the U.S. economy, as well as, global forces actually weighing on the U.S. So, as I said, our expectations are that, we'll probably sort of muddle through here for this year. But what we really need is China to get it right, and for the U.S. dollar to really depreciate, but not only depreciate on a relative against the big guys, the yen and the euro, but also these emerging economies. So. That China continued slow growth in China doesn't feed through to some of the larger positions. I mean, overall in the developing world. I mean, nobody else is really going to drive the growth that we need from a global economy other than China, and the U.S. But I mean, that's in a relative sense. I mean, if they don't, I mean, you probably should, with rates, if rates continue to come down, your returns probably should be good, but in a relative sense to the overall market, we would struggle if China doesn't sort of get it right. I mean, we wouldn't be too surprised if we saw towards the end of the year a concerted effort between the United States and China to sort of, get things moving.
So if that were to occur, would you take off some of your hedge, your dollar hedge? Or is there something that indicated you would reduce that dollar hedge?
No, I mean, again, it's the overvaluation. I mean, only if we saw the returns, some returns in some of the emerging economies really strengthen. But I think it would take some time for that to work off. That dollar strength. The dollar is now 20% or so overvalued. So, it's got a good way to move for it to really come back to, some sort of neutral position in the portfolio. And it's all valuation. It's all relative valuation. So, if we see better values elsewhere, we're going to go there. So we're really agnostic on how the index is set up. We're just looking for the best values.
Questions for Greg? Thank you very much.
Thank you.
Jason, I have a question for you. Do we have a limit on the amount of non-investment grade fixed in our portfolio?
There's not a declassified limit because they're in a commingled fund.
Right.
Do you guys have? Is there a by statute? I mean, so we have restrictions as to how much.
Okay.
You're going to look at most about 25%. That's combining emerging markets and high yield.
We do have it for the Western portfolio, for Core Plus strategy.
And what is that?
Limits.
Emerging debt.
Non-dollar loans in the Western portfolio, which is the majority of the loans, the largest percentage of the loans, is limited to 25%. This strategy is a commingled fund and
I think all with combined, it's about 25%. So
It's currently about 10.
about 15% right now in what we would consider to be emerging economies, and that's really just non-index securities that are below A minus. So
Okay, so you're counting triple Bs in that also.
triple Bs, we would, even though it's investment grade, we would consider it to be in investment grade. I mean, excuse me, that's yes, if it's not in the if it's not in the index and still in investment grade, we would consider it to be emerging. But I don't think we have any of those positions in there
Okay.
right now. But
so long-winded ways, there are limits controlled on non-5.
There are limits, but it's pretty high.
While it is controlled by the overall allocation,
Right.
is 25%. So of that, if we had one of the index fund has none, no high yield, which makes up 5%. Core Plus has a target of 7.5, it's at 11 right now. So it's at the upper bound of those targets. If it
That's reasonable. Other questions? Thank you very much.
Thanks.
Item number 4 is to receive the Oklahoma City Employee Retirement Comprehensive Annual Financial Report for fiscal year ended June 30th, 2015 and 2014. And do we need a motion to accept the financial as presented? So moved. We have a second. Any discussion? All in favor, please signify by saying aye. All opposed? Motion passes. Number 5, ratify approvals. Payroll for the month of January 2016. Motion has been made and seconded. All in favor, please signify by saying aye. Motion carries. Item number 6, approve claims docket. Motion has been made. Is there a second? Motion has been made and a second. All in favor, please signify by saying aye. Motion passes. Item number 7, approve the following applications for service retirement. Let's see, we have 1, 2, 3, 4, 5, 6, 7 cases. Motion has been made and second. All in favor, please signify by saying aye. All opposed? Motion passes. Item number 8, receive report of death, authorize payment of $5,000 death benefit. We have 2 cases. Motion's been made and second. All in favor, please signify by saying aye. All opposed? Motion passes. Item number 9, receive report of death, authorize secretary to make the necessary changes to conform to the following as listed. 1 case. Motion's been made and seconded. All in favor, please signify by saying aye. All opposed? Motion carries. Item number 10, receive a presentation from Kathy Peters or her representative concerning the application for disability, not in the line of duty. Not here. Do we need to table this?
The next item is an executive session.
Okay, so we need to go into an executive session. I guess we need to have a motion to go into an executive session, do we not?
You can ask your attorney.
Okay. Mr. Attorney?
You can do the motion to go into executive session if you wish to hear more about it. This case is very cut and dried. We believe administratively that she's entitled to the benefit disability not in the line of service. I mean, she's not coming back to work, and she's not in any capacity to do so.
So what's the difference in the benefits with not in line?
It's a reduced amount, 40%, I think, what I recall.
Both the level of the benefits is the same as the eligibility for the benefit, and hers is all medical conditions, so they didn't happen on the job, so that's the medical condition part. So she had over 15 years of service, so she was eligible for the disability, not in the line. She did not receive the full benefit, which is 40%, because you have to have 20 years of service to receive the full benefit. It's prorated based upon your service. So she did receive a 100% disability rating through the doctorate.
And in your opinion, it's cut and dried, correct?
Right, you don't have to in an executive session, you can just approve the
Okay.
disability.
So we have considered for approval the following application of disability not in the line of duty, correct? Correct. What'll be the pleasure of the board?
I'll move approval.
Motion has been made and second. Any discussion? All in favor, please signify by saying aye. All opposed? Item 11, approve the following applications for vested rights. We have 1, 2, 3, 4, 5 cases. Motion has been made and seconded. Any discussion? All in favor, please signify by saying aye. All opposed? Item 12, discuss and/or authorize. We have 3 items here. The first item is Administrative Services Agreement between OCERS and the City for administration of the 457 Plan and money purchase plans. Motion has been made and seconded. Any discussion? All in favor, please signify by saying aye. All opposed? Item B, granting a cost of living adjustment for eligible retirees and providing an effective date. That ought to be fun. What do we need to discuss on that? Renee?
In your packet, there is the information regarding the cost of living determination. The actual CPI was 0.7%. The only thing that we actually have looked at is, based upon our current financial standing, it's whether we can afford to do the actual cost of living.
Excuse me for being dense, but what's the cost of living adjustment that we're proposing?
0.7%.
Okay, so it's going to match the CPI then?
Correct.
Thank you.
Motion's been made and second. Any discussion? All in favor, please signify by saying aye. All opposed?
I need an effective date.
An effective date. Do you have a recommendation?
You can either go, you can pick any day you want. You can go back to January to retro, or you can make it February 1 and make it effective from this point forward. It's up to you.
Do you have a motion?
Well, I don't know, he said David made the first.
What have we done in the past? What do we typically do?
Either one, since it's so small, a lot of times we'll just do it from that point forward, only because when you actually start messing with their checks, meaning you give them a retro check, then another check, then another check, they're all different. Even though they're small amounts, it tends to be confusing when you're retired to have your checks change from month to month. So a lot of times we'll just go ahead, since they're very small increases, just make it effective from February forward.
Yeah, and I would like an additional motion on the effective date since the...
So I'd make a motion on the effective date just being going forward.
February 1.
Okay. Okay.
I've got some more questions, I'm sorry.
Yeah, February's checks have not been generated. They're generated at the end of the month.
Do we know what the difference in the cost would be to the system?
It's $160,000 a year.
Okay, so divide that by 12.
That's $15,000 a month.
Okay, that was my question. Thank you.
What's the motion on the table? I'm sorry.
Just to do it moving forward, not to retro it back to January 1st, just to pick it up and go forward.
February 1st.
February 1st, is that your motion?
Right.
Sure.
All right.
Yes, February 1st is my motion.
Thank you very much.
Yes.
Do we have a second? Motion's been made and seconded. Any further discussion? All in favor, please signify by saying aye. All opposed? Item C, interest determination policy. Renee, you want to visit with us about this, please?
This is the item that we discussed last month, and Diana had asked that we specifically list an item on there that if the ERS's annual rate of return was less than the Treasury yield or zero, that we did not have to, or was negative, we did not have to provide interest. We could set it at zero. She wanted that specific language, so we added that language in the policy.
So it's the same as last time, just that addition.
Correct.
Clarification.
Correct.
Okay. Do we have a motion? Seeing none.
Hey, Renee, the language is just a little bit maybe unclear to me, where it says the second to the last sentence is the one I'm looking at in the determination of interest rate paragraph, where it says, in years when the year-to-date return of the ERS is below the 2-year Treasury yield, the board may utilize a rate of 0%.
Right.
That kind of, you could read that where it suggests that 0 is the only rate that we could use. You know, that if the Treasury yield, I guess what my concern is that I'm not sure that this leaves the discretion to the board to set the rate.
We use the
It-
word may.
it does say
instead of
may.
Shall, to leave you that option. That was,
Right, but could it be 1% instead of 0%?
I mean, in years when the ERS's return is below the treasury yield, you may utilize a rate of 0, or in any rate, I mean, it's just a rate not to exceed the assumed rate of return.
Yeah, it could be any rate, including 0.
Right, that's kind of where she was going.
Yeah,
So you would suggest having, could be any rate including 0 in the
well,
language?
I guess what I'm wondering is if we added to the beginning of the very last sentence, something like, none of the foregoing is intended to limit the discretion of the board. However, at no time may the board use a rate higher than 8%.
You're fine with that?
Okay.
Yes.
I would,
So yeah, we could do that as amended.
yes, I would move that we accept the policy as amended.
And would you please say that again? Okay.
Amendment, I move the amendment,
Can you
And please restate the amendment, yes.
the language. None of the foregoing is intended to limit the discretion of the board. However, at no time may the board utilize an annual rate in excess of 8%. Okay. Okay.
We have it on recording.
So I,
Okay. Motion has been made on the amendment.
I thought maybe saying a range from
Press-
0 to 8%.
Press the button. Press the button on top. There we go.
A range from would you be okay if we said a range from 0 to 8? That way that was one of my concerns. And then also that it said year-to-date return of the ERS. I thought we needed to be very specific about the performance. Like we need to match what's on the COLA maybe sheet that we received. Look.
Francis?
I think we need to defer this
So that it's very specific on what return we're talking about.
and have it.
I might suggest we table this and send our comments to Renee and try
Okay.
to bring this to the next meeting if it would be appropriate, if everyone's okay with that.
Yes.
Okay? Do we have a motion to table
Thank
this? Do we need a motion to table? Yes, we do.
Okay.
So motion.
Motion's been made and seconded. All in favor, please signify by saying aye. Aye. Thank you very much. Thank you, Francis. Number 13, Investment Consultant Report. Jason,
Good morning.
good morning.
You have the January report as well as the 12/31 quarterly report. And then we also handed out our clear-covered year in review. I won't go through that. That's for your own reading pleasure. Just a review of capital markets last year and the economy. Very difficult year in the equity markets. You heard Greg from Brandywine talking about it. Certainly the fixed income strategies were impacted. Slowing growth in China. Concerns about Fed policy going into December. We saw the Fed raise rates. Markets certainly have not reacted kindly to that over the last month and a half. Now concerns which direction does the Fed go. All among fairly positive news on the economic standpoint domestically, with jobs numbers looking fairly good, unemployment rate at the lowest it's been in a number of years. Listening to the company earnings haven't been too bad. But all of that, the bigger macro picture is concerns about long-term slowing growth, oil prices coming down, certainly impacting certain regions and sectors in the U.S. economy, strength of the dollar, and then there's the massive volatility in foreign currencies. So all of that has resulted in essentially flat returns of your overall portfolio for the calendar year 2015. Portfolio was down 26 basis points, gross of fees, 86 basis points, net of fees for the 1 year. So as you're having the discussion on where to set your interest policy, the total portfolio actually had slightly negative returns for the year. Just looking at in the quarterly book, and I'm not going to go through the capital markets, but if you go to page 26, I do think it's important to look at these longer-term numbers. The last year has really wiped out, and we know what happens. The longer-term numbers are certainly smoothed. Those returns are more smooth than the year-to-year numbers. But now, since going back to 2002, so that's about, well, it's 13 years, the annualized return in the upper right is a little over 6% versus your policy index of 5.94, so a little bit ahead of that. You've gotten there with less risk, about 80 basis points less risk, which we would expect. We talk about how your portfolio is constructed to protect in declining markets and participate in up markets but not get all of the upside. You see in the benchmark in the middle section there are some of those statistics. The up capture, which is telling us how much of the upside are you getting when markets are up, about 90, little over 94%, but on the downside, protecting about 10%. So you're only capturing 91% of the downside, which is what we would expect. More recently, the construction in the fixed income portfolio has added a little bit of volatility, certainly to your questions about high yield. But as we continue to look out longer term, you have long-term liabilities as a pension system. As we look out intermediate to longer term with interest rates continuing to be at historic lows, you need to do some things to generate a little bit of potential extra return. On the fixed income side, you are diversified. Your portfolio is really structured to do better when rates go up in the U.S. or rates are flat and not declining precipitously. Surprisingly, we've gone through a period, even with rates as low as they are, where we've seen U.S. interest rates come down quite a bit. Even though the Fed raised the Fed funds rate in December by 25 basis points, the 10-year today, this morning, hit 152, 1.5%. I think it was at close to 240, 250 in the fourth quarter of last year. So a minimum of a 50 basis point move down for the 10-year quarter to date already. It's been pretty dramatic. So your fixed income portfolio really isn't designed, you don't have as much interest rate exposure. You're not going to do as well in periods like this on the fixed income side, but we do continue to believe longer term, despite when you're looking at what's going on with Brandywine right now, what we really are focused on is the yield advantage. They're generating over a 4% yield compared to a U.S. investment grade portfolio that's going to get you about the 1.7, 1.8 type yield on a 10-year treasury. So we have to keep in mind that longer term nature of your liabilities, and that's how the portfolio is structured. Just looking at page 27 on a relative basis, relative returns are continue to be good, are meeting expectations. For the 1 year, as I mentioned, the portfolio gross of fees was down 26 basis points compared to your policy index down 87 basis points, so outperforming a little bit. Net of fees, you're basically in line with the policy index. Relative to peers, we show two peer groups. One is other funds. These could be corporate or public pension funds, endowments, foundations, with a similar risk allocation, 55 to 70% equity. That's pretty wide, but that's still looking at funds similarly situated with long-term liabilities. You're in the 43rd percentile over the 1 year, relative to public funds in the 63rd percentile, a little bit below median. 3-5 years in the around the 30th to 35th to 40th percentile. 5 years are in the 30th percentile. So good good relative returns. You look at the next page, 29, that's just looking at rolling one-year periods, and you can see, over the last 5 years, we've had 2 really good years, and I think this is important to keep in mind. We know returns are going to be like this. You're not going to get 8% every year. Returns are, if that happens, well, it'll be a stroke of luck that one year you got an 8% return, which is what your target is. Some years are going to be above it, and some years you're going to be below it. And when you are above it, you're banking that surplus, and when you're below it, you're using that surplus to offset that, and you're seeing that reflected here. From a manager standpoint, just go to the monthly report. A couple things on asset allocation. I know with the volatility in the markets and equities selling off, the allocation has changed a little bit. You have been a little bit overweight to equities for some time. We've been using equities to meet your operating needs. I think just this last month we actually used fixed income, the Western portfolio, the Core Plus strategy, which is the most overweight within fixed income. So if we look at the end of January, equities overall were about 40 basis points overweight, so essentially in line with your target. Within equities, large cap and small cap U.S. were slightly overweight, long short slightly overweight, non-U.S. And emerging was underweight, and private equities a slight underweight. That's really a function of what's done better. U.S. stocks have done better than international stocks. On the fixed income side, the Core Plus is the most overweight. We had that tactically overweight, if you will, coming into the year, or really for the last several years. Coming out of 2009, we've been at the higher end of the range for Core Plus, and that's been a positive. Using that now for rebalancing needs and to pay operating needs. Real estate or real assets broadly, your real assets are underweight by about 2.5%. Most of that is to the opportunistic real estate, which is funded like private equity. You just haven't got that program fully funded yet. If we look at the real estate, core real estate actually did very well over the last year. It was the best returning asset class and your best returning manager by far. So the real estate component of real assets did very well. You were overweight your target, 8% versus 6%. Commodities brought that down. Think of the themes that slowing growth in China, that has slowed commodity, it certainly pushed commodity prices down, declining oil, money coming out of sovereign wealth funds of countries that are large commodity producers. So if you look at, on an asset class basis, emerging markets and commodities are your worst areas. They're also your smallest allocations because of how volatile those areas are. So page 2, this is rolling forward a month, so the one-year returns look a little bit different. January was a difficult month, and February has started off that way as well. So now the one-year number for the total fund is down 3.8 net of fees, 3.2 gross of fees. The policy index is down 3.4, so you're roughly in line with the policy index. Large cap, which is for the most part passive with the enhanced Intech component. Intech did very well in the calendar year 2015 on a relative basis, added value. It detracted about 60 basis points for the month. Small cap detracted about 55 basis points, I should say, for the year relative to the policy index. Long short equity has been a positive relative to the HFRI strategic benchmark. This is a global, your long short is a global strategy, so if we compared that to a long-only global benchmark, it's underperforming the S&P by a little bit, just large cap U.S. stocks that have done a little bit better. Private equity has done very well. Now, private equity is a little bit different. It's not mark to market, so you're getting a benefit just from an accounting standpoint, but also private equity did well last year. There was a lot of realizations within the portfolio. You got some distributions back. Some companies were marked up. So that private equity allocation, albeit small, relative to the S&P 500, our large cap stocks on a one-year basis now, has added almost a 10% premium on 4% of your portfolio. So that's been a positive offset. International, despite being down, your managers have done a good job protecting in the declining market. The developed managers, Lazard and Harding Loevner, down 6.3%, whereas the EFI benchmark is down 8%, so they've added about 1.5%. Emerging markets, there your managers have added quite a bit. I mean, it's the worst. If we look at this, you'll say, well, that's the worst performing asset class. The benchmark's down 20, your managers are down 13. They're down a lot less. This is where they're adding value by protecting in this market, and we would certainly expect that from Von Tobel. Both Von Tobel and Wasatch are underweight to China, so that has helped. If we think back last year, April of last year, through January through April of last year, the China market was booming. The China stock market was booming, and these two managers were underperforming by about 10%. But they did not believe that that was sustainable, and that you've benefited from that coming into now on a relative basis. As I mentioned, real assets, slightly positive, even with the decline of the commodities. Your overall real assets, a positive 90 basis points, and really that's all coming from the Morgan Stanley fund. We don't have 1 month number, but the 1 year return for the Morgan Stanley fund is almost 14.6%. That's updated quarterly, but very good returns from core real estate. Last year was added to the returns of the portfolio. So just looking forward, our themes this year continue muted return expectations with very low levels of yields and interest rates, continued volatility in the markets. We think it's going to be important to maintain diversification, active management now. You're starting to see the benefits of it, not benefits of it in terms of absolute return, but benefits of it in terms of protecting. It's been a pretty rough road for active management from 2009 to 2015 because as the markets have gone up, the rising tide lifts all ships, and it's harder for active managers to really discern themselves and add value. But now we're starting to see that change as the markets have become much more volatile. Finding growth is much more scarce, or finding true value is harder to do. And active management is paying off on a relative basis. You've got that in your portfolio. Staying disciplined to the long-term nature of your asset allocation, rebalancing. Despite the strengthening of the dollar over the last year, we think having a dollar bias in your portfolio is appropriate as a dollar-based investor, and most of your assets are in dollars, but having some currency diversification can be a benefit. Certainly hasn't been more recently, but longer term we think it's appropriate to have some of that in your portfolio. We say these things because a lot of times when markets are going like this, we're like, what do we need to do? And I think the first thing is it's important to remember that you have a strategic plan. We know markets are going to go up and down. Unless something's fundamentally changed, we don't necessarily want to make changes in reaction to what's going on short term. We have no current issues with managers from a change in course standpoint, and just as far as rebalancing and operating needs, we would suggest continue taking from the Core Plus, which is the most overweight. Any questions on the portfolio or managers?
I have a couple. On private equity, how often is that valued?
Well, we're updating the individual partnerships valuations are quarterly, and they lag. They lag by probably 60 to 90 days. They could lag a quarter. But the number that we use, Randy, if you go, it's page 5. The number that we're using as the carrying value is this adjusted ending value column. So what that is based on, we'll just use Mesero as an example. We're taking we have a carrying value for the investments based on the last reported valuation,
Quarterly, which could be
For-
6 months.
which could
because
be
it says
6 months
90-day
ago.
lag.
And we adjust that for any capital calls or distributions that occur in between that valuation and the next one coming out. So if they distribute back $1 million to you, we're going to reduce the carrying value by $1 million. That doesn't hit performance, but it adjusts that. So it is an estimate, but it catches up over time.
Thanks.
So it's just not, the valuation itself, the actual valuation, isn't as frequent as your public market stocks. So when we look at returns for private equity versus public markets, they tend to lag. The private markets will lag public markets in terms of returns and just won't be as volatile because it's not valued as often.
Forecast for what the Fed's going to do over the next year to 2 years?
2 years or the next 2 months? I think, coming into the year and even through the end of January, it's data dependent, as the Fed is saying. Right now, the data on the economic side in terms of jobs and wage growth is not necessarily indicating that they would change course. I think what's happening in the markets potentially could, and concerns about slowing growth, potentially could lead to just a delay. We don't see them reversing course and lowering rates again. There's not much room to lower them, but perhaps a delay in the rate increase cycle.
Okay. It's coming, just when?
Yeah, I think before we were probably thinking it was going to happen in March, but I think it'd be pretty difficult for the Fed to raise rates in March, unless something dramatically changes in the markets over the next 4 weeks or 5 weeks, which is probably not going to happen.
Other questions?
My question just focuses on Brandywine. I know you said you didn't recommend any change in managers, but specifically Brandywine, you're comfortable with their meeting expectations?
Yes.
Okay, thank you.
Yeah, the issue, slowing growth in China, pressure on commodity prices and emerging markets. And they have exposure to emerging markets, emerging market currency exposure, which hurt them. But if we look from what they do philosophically, they are truly a value-oriented manager. We're talking about fixed income, but they are value-oriented. So they are the opportunity there today, and even in high yield. Well, high yield, the things that are more in the news, not necessarily commodities so much, and oil, because that's going to be really dependent on growth. But valuations in certain sectors like high yield and certain country debt, we think have overshot themselves, and there are some pretty compelling values out there. So we could see some bond strategies generating some pretty outsized returns. We have a fixed income summit every year in January. We have 3 or 4 fixed income managers, bigger macro thinking people come in and talk to us. We had the head of the J.P. Morgan kind of global go anywhere bond strategy in. I haven't heard a manager more excited about their portfolio since 2009, which was a really bad time where you saw spreads really wide because of just compelling valuations and the built-in protection just from the yield advantage. Now, security selection is important. A lot of the energy names that are questionable. The spreads in the high-yield energy sector have blown out to 14, 15% above treasuries. But other sectors, other high-yield sectors are still a premium of 700 to 800 over treasuries, which is pretty attractive, kind of yield advantage if you're discerning in selection. And those companies nothing fundamentally has necessarily changed in those other areas. So there could be some compelling opportunities there. That's not to say that we're huge bulls on the market. We just think that there's some compelling opportunities in certain areas that come from this.
Jason, what's your outlook on the price of oil?
Yeah,
At least 5 years out. Huh?
I can't even go there, Jim. Our firm outlook, not necessarily on the price of oil, but just on the supply-demand imbalance, is that that will start to abate as the year goes on. And it's just a naturally occurring phenomena as producers at this price will you start to see a slowdown in production at some point. And at some point you get equilibrium. But as far as predicting price, my guess would be a wild guess.
Are you seeing managers showing an interest in getting into oil now, seeing that as a value opportunity, or?
I think everybody's really cautious about oil, but looking at the energy sector and some companies that may not be as sensitive just to the pure price of the commodity, but the valuations are so compelling. So yes, we're seeing a lot of, not so much on the public equity side yet, but we're seeing a lot of private equity funds, and this is not new. I mean, even the most recent fund you went into, Warburg Pincus on the private equity side, I think they're going to have a pretty big slug of energy in that fund just because of valuations. But they're able to put money to work over time, and they don't have to pile it all in right now. But we're hearing from managers on both the debt and equity side that are creating new one-off strategies to take advantage of dislocations in the energy sector. But most are still treading cautiously and not necessarily ready to jump in full bore at this point.
Other questions?
Thank you.
Thank you, Jason. Additional comments from the board staff and/or citizens? Lots of fun. Just a reminder to send the comments and thoughts on interest determination policy to Renee, is that correct? And we will have that next time. Do we have a motion to adjourn? Motion's made and second. All in favor, please signify by saying aye. We are adjourned. Thank you very much. Well, with your help.
Sorry, guys, I had to run off.
Good job.
Thank you, Jason.